Hello everyone, welcome again to Hybrid Accounts YouTube channel. And today we're going to start with the new topic, cost volume profit analysis, simply abbreviated as CVP analysis. All right, CVP analysis, just as the name itself specifies, just establishes a relationship between cost, units of production, and sales, which is sales volume or production volume, as well as profit. So throughout this one, we'll be dealing with the relationship between costs, volume, as well as profit. Okay. So actually, when dealing with cost, there are several ways of classifying cost. You can classify by behavior, by function, and by nature, etc. So CPP analysis involves classification of cost by behavior, meaning that costs are divided into fixed and their variable elements. Actually, sometimes we could have semi-variable costs, which have both fixed and variable costs, but that's none of our business. What we need to know here is that we expect to be able and to be in a position to break down cost into their fixed and variable components, right? Okay, so we start from the very, very basic formula, which we certainly know that to obtain profit, we usually take sales, revenue, and then we list the costs incurred. So cost of sales, operating expenses, actually, simply speaking, all costs, right? Okay, so after this one, we can divide our cost into variable elements as well as fixed elements. So it's just very basic that I say profit equals to sales revenue minus variable cost minus fixed cost. And after deducting such costs, we will have complied with the classification of cost by behavior, right? Okay, so we now define what is sales. Sales equals to selling price SP times unit sold, which is Q, just abbreviated as Q. And then we have variable cost, which is variable cost per unit times units sold. And then we have the fixed cost. Now, as for fixed cost, we usually put it as a whole. Fixed cost is incurred per period, right? It does not change with the level of output, unlike variable cost and selling price, right? So that's why for fixed cost, we take it as a whole for the entire period. Okay, now if you see it, you can just observe that we have Q here, but also have this volume here. So you can put this volume out of the bracket, after which will remain with the difference between selling price and variable cost per unit, then times quantity times Q also or volume minus fixed cost. All right. It's a simple formula, but this formula is the basis of all of the cost volume profit analysis, right? So selling price minus variable cost per unit, we obtain contribution margin per unit, CMU, right? So simply speaking, profit equals to total contribution, which is contribution margin per unit times total units minus fixed cost, right? Okay, so this too is the other basic formula. Why do we call it contribution? When you just start the business, you will have to incur some fixed costs, regardless of whether you have produced something or not, regardless of whether you're earning something or not, right? Yes. So what we mean by contribution, contribution is the excess of the earnings you generate over the variable cost you incur each time you make a product or you sell a product, you buy a product, right? Something like that. So contribution is simply the extra earnings that are geared towards covering fixed costs and thereby covering the losses and ultimately earning the profit. Without contribution, the company would never be able to break even. It would never be able to recover all the costs, all the fixed costs incurred, right? Yes, something like that. So whenever variable cost exceeds sales, you would never, whenever variable cost per unit exceeds selling price, you would never be able to recover the fixed cost initially incurred. All right. So profit can be abbreviated as pi. So you could say profit equals contribution margin per unit times units, then the whole value is deduct fixed cost in total. These are just the symbols. Despite represents profit, Q sales volume, contribution margin per unit, CMU, CM total contribution margin, something like that, right? Okay, so there are some questions to ask ourselves, and that's why after here we have to study the assumptions of CVP analysis. It doesn't just come. There are some assumptions attached, right? First of all, it applies to one product only, or to more than one product if they are sold in a constant sales mix. So at its very basic, CVP analysis assume that the company deals with just one product. It either makes one product or buys one product, right? Yes. But actually, later on, we'll go on and find out that it is possible to apply CVP when the company boasts more than one product, let's say 2, 3, 4, or more products, right? With something like that, it could be done. But in that way, we say that if they are sold in a constant sales mix, meaning that these products are sold at a common ratio, either common ratio in terms of units or in terms of sales revenue, right? Okay, something like that. But another point to say fixed cost per period are the same in total at all levels of output and sales. Same fixed cost. Actually, we could refer to this formula here. Fixed cost the same, or here fixed cost, same fixed cost. Variable cost per unit is constant, selling price is constant. And as for Q here, the first Q was multiplied by selling price, so it means units sold. The other Q was multiplied by cost, so it could be relating to units produced. So for the Q to be the same, all units produced should be sold, right? Or should be two. It could mean that no inventory is kept in store. So that's why you say unit variable costs are also constant, as you saw from the formula, but also sales prices are constant at all levels of activity. Production volume is equal to sales volume, as we saw that formula above. Then cost can be broken down into fixed and variable components. If you have the cost and you cannot break it down into fixed and variable components, you cannot apply cost volume profit analysis. And that's why in that formula, we showed all that, right? And then costs are affected by the level of output only. And the last point, costs behave in a linear fashion with the changes in the levels of output. All right, so that's all about the assumptions of the CVP analysis.